RedSwan is a Houston-based company. We actually have an office here on the 3rd floor here in the Ion. And I've traveled all the way around the world presenting on tokenization. We just came back from Davos at the World Economic Forum speaking on tokenization and real-world assets. And I said, why am I not talking to our Texans who own real estate and making it plain for them so that they don't miss out? So that's one reason why we're here. We're going to talk a little bit about tokenization, and then I'm going to show you a couple of slides to give you a little framework, and then we're going to go into question and answering. So in general, when we look at tokenization, you look at an opportunity as a property owner where you don't have to sell your property. I think if once you tokenize an asset, I think selling the property becomes an issue that you don't ever want to do. And I think that way you can start building your assets under management much faster. You think about how is that possible? Well, if you everybody has at least 30 to 40% of equity trapped in your properties on a regular basis. Some have more, depending on how long you've owned the asset. But that's a lot of dead weight on your asset. I would say opportunity cost is being lost because you can't pull it out until you sell. And you're usually forced to sell because you have investors that you promised that it'd be a 2-year, 3-year, 5-year turnaround period, and they're asking you for their liquidity, so you have to sell. But then we have markets like today where you see interest rates are much higher and cap rates are also much higher. Your target for exit is no longer available, and therefore you can't sell unless you're going to take an unfortunate loss in the transaction. So tokenization is a way that you can avoid that situation by taking your debt or your equity and convert it into digital securities. When I say digital securities, that's a lot different than saying Bitcoin or cryptocurrency. It's actually a security like a stock certificate that you'll see on Wall Street. Which, another matter, Wall Street is also going digital, so you'll see stocks are now being turned into digital securities as well. But that's what we do, and we think that these create a lot of optionality for you that you've never had before. For example, being able to take a certain percentage of your equity and sell it to the marketplace. So you might sell 10%, 20% of your equity to raise capital to avoid having to sell a property. Think about today's market where you borrowed money 3 years ago at X price, and today your mortgage is coming due at X minus price, and the bank is saying the only way they're going to give you a new loan, it won't be at X price, be at X minus price, and you have to bring cash to make the difference. Does that sound familiar? Well, if you tokenize your asset, you can actually try to do two things. One, if you didn't want to sell your stock, you can actually borrow money based on a certain percentage of your stock that you lock into an escrow, and people will now will give you money and take a return of yield that you're promising. It's called staking. Two, you can take your equity, you can sell it out with people like RedSwan and have equity owners come inside, both national as well as international investors who can look at your investment. And so that's another third option, is that when we start talking about tokenization, we're really talking about global capital. We're no longer just looking into the friends and families of the United States or the major institutions. You're now allowing people from all over the world to look at your opportunity and say, I'm making yen right now, and the yen is probably 1/10 of a dollar. I would love to be able to take my yen and buy an asset that's paying me in dollars, because now I'm hedging inflation that I'm seeing in my country that's at 18 to 25%. Makes a lot of sense for them. So they're probably more willing to put money into your asset at a discounted price because their capital is actually falling down every day based on inflation. So that's why global opportunities, I think, makes the situation much more interesting for you as an investor. Here's a great example of what's happening in today's market. This is a company, it's a REIT, that was valued in 2022 at $1.3 billion. And today, they've been extending their loan that's coming due. This is now being extended by 6 months. The bank says you have 6 months to bring $100 million in, otherwise we foreclose on the asset. So blend and extend worked out pretty well in the past because there was a different set of circumstances. But today, that if a bank is saying you have 6 months, they're actually looking at the back door, talking to investors who might want to buy that note so they can just do away with the property, which means you lose your property. So that's one example of someone who could have used alternative solutions to try to find capital, and maybe they're going to, so I did reach out to them. to try to find other capital in the next 6 months in order to bring this down? Because going back to the usual suspects that you've gone to before, probably going to get you the usual same results. Either they're going to bring somebody who buys your property at a reduced price, like Blackstone or BlackRock, or they're going to bring a lender, a private lender, who's going to charge you 16, 14% interest on that loan to close the gap because you're desperate, or the property goes into foreclosure. Those are the three options using the current circumstances. Here's another result. This is the bigger company, $851 billion assets under management. They knew what was going on. They foresaw, as Ethan was talking about, they see the future and said, look, we think right now capital is getting tighter. And it's hard now for us to get qualified investors who can put $1 million minimum into our funds. And therefore, we need another way to capitalize our REIT. So what do? They tokenized 3 funds, roughly $20 billion. And now they're lowering the entry rate from $1 million to $20,000. And they're having more success bringing capital in from around the world than they did before. So that's an example of a company that's $1.3 billion, what they did, and an example of a company that's $851 billion and what they're doing. Just to give you some clarity on that. Compliance is very important because many people came to our space 4 or 5 years ago, and they were saying that they were not selling securities, so therefore they're selling utility coins and all these kind of ICOs were coming through the ground. But that was a problem for the SEC, and the SEC in 2018 shut down all of the companies that were doing ICOs. But on the other side, they recognized that blockchain technology is very significant, and they legalized security token offerings, which is what we sell, securities. So right away, we knew we had to get a license from the SEC. So the first license we went for was our IRA, which is our registered investment license. And then also, we just got approved for our broker-dealer, our digital broker-dealer license, which is, I think, setting us, way ahead of many in the industry because it took us over 1.5 years to get to this point, to get this license. And now we're able to comfortably talk to major institutions about doing business with them because they know that we're licensed with the SEC and FINRA, and therefore we're doing everything according to US regulations. We just came back from Davos. There was many companies that we talked to. The top topics in Davos was AI, real-world asset tokenization, and mental health. So when we had our presentation, we had a packed house to hear about tokenization of real estate, because again, that's one of the largest asset classes in the world. But it gave us an opportunity to continue talking to some of the major institutions in the world, like Fidelity, BlackRock, Deutsche Bank, Goldman Sachs, Morgan Stanley, JP Morgan Chase. They're all moving digital. They're all already doing digital transactions. JP Morgan Chase is already doing $850 million worth of digital transactions on the financial side per day today. And so they're looking at how they can extend those benefits of using digital technology into other assets they have under management. So many of them are putting mandates out there saying that by 2030, which you can see, Boston Consulting Group is already estimating the tokenization is going to hit, $16 trillion in the next 7 years. That's a lot. When you look at assets, that means a lot of real estate and a lot of assets, gold, diamonds, will be tokenized because of efficiency purposes. But these companies are saying we want to set up a mandate so that by 2030, maybe we have 8% or 10% of our assets under management be digital. Why? Because it saves them a lot of money. I'll give you a quick example. Fidelity, who has a management division to do an wealth management division, they manage trillions of dollars worth of assets for customers. Real estate is an asset that is an alternative asset, so therefore it doesn't fall under their AUM, and they don't charge AUM fees for that. However, if we now digitize real estate and make it liquid, they can now add that to the pile of capitals they're managing, which generates more fees. So there's a strong incentive for the institutions to go digital because it helps them generate more money. And also, you think about buying real estate. You get paid when you buy, but you actually clear your money when you sell. And so if you're able to sell your real estate on a term and a dime without having to worry about the actual asset being sold into the market, and you can just sell the equity out tomorrow, you can now create your IRR instantly, which is more valuable to an institution and to an investor than having to wait to some unforeseen date in time that you get to sell your asset. Like today, you can't sell your asset. If you want to sell your asset today, you're actually dumping your asset because you know the market is not strong enough to support the kind of price you're looking for. So I'm going to let Shayne talk a little about distribution, because we work with Hedera, and we're very proud to be working with Hedera Hashgraph, which is a DLT blockchain company. They have millions of users who are using their blockchain coin, their crypto coin, to do different types of applications. But there's a use case that I'm going to let Shayne talk about, where bringing digital real estate in is something that their customers are very interested in absorbing and buying and trading. So I'm going to hand this off to Shayne and let you take it from there in terms of distribution.
Great, thanks a lot, Ed. Nice to see everyone. Thanks for coming out. So Hedera Hashgraph is a layer 1 protocol in the blockchain space. And so a couple of things that I think are important before I go into some use cases. One, why do people use blockchain, right? It's the immutable properties of a blockchain that will forever live. So if you chronicle a transaction and in a smart contract, and it gets written to the blockchain as here's the buyer and seller of a property, that is forever on that blockchain and can then be leveraged for future transactions. A couple of other comments. One, tokenization. We've been, Ed's been using that comment or that word. What does it really mean in the case of cryptocurrencies? It's really a digital representation of a blockchain asset. It's that simple. Then, what is a stablecoin? Because I'll talk about stablecoins here. A stablecoin is simply a specific type of tokenization, where it is pegged, a stablecoin is a digital representation of something pegged to a real-world asset. That could be a fiat currency or a piece of real estate. And so when we think about Hedera, this isn't just the art of the possible as to what is happening on our chain or on our network. It is actually happening. Use cases, real-world use cases. So today, we've got Aberdeen, which is a $500 billion asset under management hedge fund out of the UK that has tokenized their 15 billion sterling money market fund. They're now in the process of tokenizing their real estate fund. We have something called Stablecoin Studio. So if you have a set of assets, you've got a company, let's say you've got 5, 10, however many $1 billion worth of real estate assets, you can create your own stablecoin to be able to fractionalize the ownership related to all of the assets that you own. And then you could sell those stablecoins on marketplaces like those of RedSwan. And so it allows you to control and fractionalize all that you have. Why? Because oftentimes, and why is someone like Aberdeen that probably doesn't have a problem raising money and getting LPs to invest? The reason is it democratizes who can invest. Today, if you're trying to invest in a fund, you have to be an accredited investor, probably at least $1 million of assets. But what if you're marginally wealthy and you could write a check for $500,000? These types of capabilities democratize it, open up the aperture for the Aberdeens and the commercial real estate folks like you to be able to get additional funding to buy the things that you want to buy, as opposed to syndicating it across maybe 3 or 5 parties. What if you syndicated it across 50, 100 parties, and then they could decide if they wanted to sell their fractional share in the next 6 months because it's, they've returned X, and you can still hold on to the asset. So it's incredibly powerful. We have a ton of use cases on our network today. I've just given you a couple. We've got stablecoins from some of the largest banks in the world, whether it's Shinhan Bank out of Korea, Standard Bank, all of these banks, DBS out of Singapore, are taking this technology and leveraging tokenization to change the way and shape that their customers and their consumers engage with their technology.
Awesome. Couldn't have said it better myself. Thank you, Shayne. Really appreciate that. I mean, he talked about stable coins, and he just kind of let you know that that's just a bank, in a way, is making a currency that's in their name that they're allowing their customers to use so they can have the privilege of buying digital assets. And so We know what's going on with Shinha in South Korea, but we're also seeing the same thing from Chase here in the United States. And if you think about it, the M1 supply is roughly, what, $24 trillion of all the currency moving around the world. We know that cryptocurrency topped off a couple of years ago at $3 trillion of that currency floating around. As more stable coins are being created by banks, which are supported by the US dollar or their central bank in whatever country they're in, that means there's going to be more digital currency in the world floating around. And just like you think about websites back in the 80s when we were building websites and people said, I don't need an e-commerce website. It's not important to me. People are going to come to my door and make a sale. Well, look what's happening now. 60% of the sales are going through e-commerce, not through the front door. That's why Amazon's one of the biggest companies in the world. Same thing goes for stable coins. When you start not accepting a digital asset as currency, you're missing out eventually on half of the world's money supply. Think about it. So I'm going to share with you just some of the properties we put on the blockchain just so you can kind of see what's happening. We just brought on a very large portfolio in the Middle East that we're very proud of. It's roughly a $4 billion portfolio. Just see if you can relate to some of the asset quality that we're putting on chain. I'm going to just talk over it a little bit if you can hear me. These are development sites. So 20% of the whole overall portfolio is development sites, where they'll be building mixed-use projects. So you can see the development sites right here. And then you see the stabilized properties that are on the marketplace that we're going to actually sell equity for. This is multifamily. There's retail components, schools, office product. This is retail product, mega centers. But also there's infrastructure, the industrial infrastructure. This is a 188-acre farm built on the desert, producing alfalfa for the livestock. This is guaranteed income coming from the government. This is actually a fish farm that produces about 2 million pounds of fish a month, feeds the entire GCC. So these are major investments. This is where the World Cup was handled in a city called Lusail. You can see the high-rises right there that they own, but the pad sites right next to them will be additional high-rises going up. So they see the world changing and going digital, and they've hired us so that we can digitize their portfolio so they can continue to expand the developments throughout the Middle East as well as through Africa and parts of Asia. So this is just an example of what people are doing right now, and I see more of it happening outside the United States, but I think that what the role for the United States is, equity is very important right now. Capital is hard to get, and we want to be able to help you get this capital by opening up the market for you to be able to showcase your assets to those institutions that are looking for digital assets to invest in, as well as the public sector who's looking to invest in digital assets as well. If you're not digital, they don't see you. So with that, I'm going to have our moderator, which is Kyle Sonlin, to go ahead and kick off the panel discussion. Thanks.
Yeah, well, thank you for everyone for being here. This is such an amazing location, and Houston is just such an incredible city with so much great development, both in the real estate space as well as tech, and with the involvement of the city and the universities here. It's really an exciting place to be, so I'm really proud to be here. Thank you to Ed and the rest of the RedSwan team for organizing an incredible event and for hosting us all. And of course, we have Ed and his business partner, Don. They are unbelievable innovators in this industry. Very much looking forward to diving into it. And then, of course, Shayne here. We have a great panel set up today, but first I just want to see a raise of hands. From everyone in our crowd, raise your hand if you've done a real estate deal, you've worked in real estate, or you have expertise in this particular industry. So if you've done anything in real estate, raise your hands. That's a big group here. So what I do want to say is I have questions prepared, and we're going to get into some good conversations, but we do want to engage the crowd. And the goal here is not to get so technical that it doesn't become realistic for traditional real estate developers or professionals or investors. So as you have questions, I would like to open the floor. So whether that means raising your hand or trying to flag me down, or if we run out of questions here, opening up the floor. But I want to get other people engaged. And if you have questions, if you are interested, definitely let's make sure that those questions get answered. So with that, I want to kick it off with just a general question to Ed to lead us off. And you mentioned that the value of tokenization, this whole blockchain component, the real benefit here is democratizing investments and creating a new financial environment for the real estate space. Could you talk a little bit more about what that actually means in practicality for a real estate owner?
Sure. Good question. Well, you guys know me. I've been in real estate for 20 years. I was at Cushman & Wakefield as the executive director for capital markets, sold a lot of properties, and so I was able to really see the industry from the inside out. But one thing I noticed when I was doing business is when I took on a property for my clients, I just had to make 25 to 50 phone calls to the top institutions that are buying that kind of product, and then it was a bidding war to get that product sold. So, the problem was that it was always that same Rolodex. Never people from outside who are buying it. I take that back. I used to fly to China and bring in offers from China to buy, but those were also major institutions who were buying real estate because the price point was so high that the average person could not invest their capital into a quality piece of property. Most of the average person who is investing under $100,000 is buying a smaller, more problematic, what we call C-type properties because it's small or it's old, but not the Class A properties that you're sitting in today. It was only available to institutions or high net worth investors. And so that was a big problem for me. I thought that it'd be nice that I can sell properties to people I know, my family members, my friends, and that was a big problem. But now with tokenization, we're actually able to break the price point down so it can go as low as $500 for a person to buy a pro rata interest in your property. And that makes a big difference. And also, another major problem with investing was if I put in my $100,000, I don't know when I'm going to get it back. I don't know when I'm going to exit. They promised me it might be three years, could be 5 years, but that's not a guarantee. And so many people who only have $100,000 in their bank account aren't going to put it all into a piece of real estate because they may have a life-changing circumstances where they're going to need some capital, and there's no way for them to liquidate their investment and try to get that whole money back. So when you use tokenization, you're actually allowing people to buy in at a price point they can afford, and then also have the liquidity. So when they want to sell, they don't have to wait for the asset to be sold. They can basically put their shares on the exchange and tell the whole world, I want to sell my shares at X price, $1.25 a share. I want to load 10,000 shares. And then the people who are in the audience of like our marketplace will look at it and give them a counter offer and say, hey, I'll either accept your offer or I'll offer you $1.15 a share. But it gives them an opportunity to get liquidity, which I think is very, very important. And I already talked about the fact of democratization for the property owners, so I won't repeat that, but it allows you not have to sell your property as well, to be able to raise capital without letting go. So think about selling 90% of your asset, the equity in your asset, remaining as a GP of that asset for infinity period of time, and being able to crystallize your promote perpetually every single year. So if you are promising your preferred shareholders 8% dividend every year, and you're now generating 12% profit every year, that's 4% you're now splitting on a promote structure, which you're all familiar with your investors. Every single year that you get that kind of promote. That's a whole lot better than waiting 10, 15 years to sell off the asset, figure out how much you've made, and then realizing you were promoted at that time.
So that falls in line very well with how Ethan described the opportunities with commercial real estate and mortgages and how the financing angle is a huge drive for any asset owner, especially when you're talking about having debt maintenance and things like this, recapitalizing the properties. That's so important. It makes a ton of sense. I want to kick it over to Don and hear your perspective as well. For a traditional real estate owner, what are the first steps involved in tokenizing, and what does that look like outside of just financing? Because while financing, I think, is really the key opportunity here, that can be a little bit overwhelming potentially for somebody that's just trying to get involved. So if we were to work with a Hedera DLT or a different technology platform, what does that look like for a property, and what are those first steps? What does that actually mean?
Yeah, sure. So yes, the first step is actually not a technical step. So like with any real estate, there'll be an evaluation of the property to understand what is the value of the property. We'll do an assessment to see if it even makes sense to go through that tokenization process. And then after we do that, then there's some legal steps to actually get approval from the board of directors of the ownership of that property to transfer it from basically analog stock certificates into digital tokens. Once that's done, then we do what's called minting, which is we create these digital tokens, which are basically securities recognized by the SEC, that then represent equity ownership in the single purpose LLC or whatever entity actually owns that asset. And at that point, you've now digitized your property. Those tokens go into a digital wallet, and you as the owner of the property still own all of those tokens at that point. You haven't actually sold them off yet. And then at your discretion, you can decide what to do. You could sell, as Ed said, maybe 10% of them off to the market, hang back, get your capital. Maybe at another point, you decide to sell another 10% off, and so on. So it's always in full control of the owner of the asset.
Right, okay, so that digital token in the wallet is the same thing as the traditional share certificate that we may have created from a legal document?
Exactly, and I think that's one of the most important concepts for people to get. We're dealing with securities, and we have from the 1934 or 1933, we have securities laws. Those laws apply in the exact same way to these digital securities as they do to all the securities that we trade in the stock market today.
And so, kicking the conversation down the line here to Shayne, could you talk about what it means to be the technology provider behind real value in real estate? I think that people, when they think of cryptocurrency, they've seen a lot of negative headlines, right? So obviously, we can't have that same kind of hacking and stealing and all that kind of stuff applied to real estate assets or real ownership and stuff. So how do you and your team kind of manage some of the technicals on that front? How do you work with RedSwan to make sure that doesn't happen?
Yeah, if you listen to Elizabeth Warren, we're all thieves, and if we work in this space, and we're not. And specifically, why is Hedera different from any other blockchain in the world? And it's our governance model. So we have some of the largest multinational companies in the world that run the nodes, the computers of our network. The list is Google, IBM, Boeing, ServiceNow, Dell, Avery Dennison, ITT Madras, Shinhan Bank, Standard Bank, Nomura, and the list goes on. Reputable companies that have real brands that can get tarnished if you do bad things. If you build this on another chain like Ethereum, two things happen. One, significant fees in doing some sort of transaction. They're called gas fees. So one transaction, maybe you're trying to buy something for $500, could cost you $200. That doesn't make sense. That's number one. Number two, you don't know when that transaction executes on an Ethereum where that transaction goes. Who's running the nodes of that network, right? And that's part of the whole idea of decentralization. But you don't know if someone in the South Sudan is running a node of the network where now you've got an OFAC issue, et cetera, et cetera. With us, we're a public permissioned blockchain today that has 31 nodes of the network, these big companies running. So that's the first place. The second thing is all of our fees to execute transactions on the network are fixed to the US dollar. So you know when you're building your business how much you're going to pay per transaction. So we've got 3 transaction types. I know we're not technical in the room, so I'm not going to even go there, but I will say this. The cheapest transaction is 1/1000th of a penny, 0.0001 cent. The most expensive transaction is $1. And there's more of the 0.0001 transactions than there are the dollar-based transactions. And so those two things make us incredibly different. And then the last thing is performance and security. Today, we are running at a little over 1,300 transactions per second today. We are faster and doing more transactions than every other blockchain combined. We've done over 42 billion transactions to date. And then from a security perspective, as a result of these large enterprises and the technology, we're more secure. So that's what makes us different.
So there's a few types of security. That's a really interesting one. But then there's also the legal and compliance protections around the securities themselves. So Ed, can you talk a little bit about the U.S. market versus the international market? Because the cool thing about RedSwan is that you're really doing a great job in capturing both the international market as well as the local market here in the United States, but they are incredibly different in terms of how they facilitate these types of capital formation events. So could you just kind of explore the differences between the two and really ideate where the opportunities are?
Yeah, sure. So you have Reg D, which most of you are familiar with in the U.S., which is basically selling to accredited investors. And then we also have Reg S, which is selling to foreign investors. With the U.S. accredited investors, there's more regulations for the FINRA and the SEC with regards to selling securities to, first, people who are not accredited. You cannot do that unless you formalize like a Reg A or Reg CF for the non-accredited investors, but that typically takes 6 to 8 months. So we'll see Reg D are the accredited investors or the qualified investors. There's a KYC process that is necessary for all investors, whether it be Reg D or Reg S. Why? Because we want to make sure that anyone investing in your project is not a terrorist or criminal or has a history of money laundering. So they go through a process where it scans their ID, whether it be their driver's license or their passport, to run a background check on them. That takes roughly 24 hours, and they come back with either yes, they're accepted, approved, or no, they're not. So that's a regulatory construct that we use on all investors. Then there's also in the U.S. The regulatory framework of not allowing a U.S. investor to buy an asset, your asset, and then turn around and sell it within 12 months. They want everyone to be able to buy an asset, hold on to the asset for at least 12 months so that there's no games being played in terms of pumping and dumping of a transaction. So, but on the Reg S side, they don't have that qualification or the regulatory compliance. So on the U.S. side, what we do is we set a time period of 60 days and sometimes 90 days, so they have to hold the asset before they can sell it. But the U.S. is very strict about what's being done because they want to make sure that there's no fraud taking place on the investors. Also, as Don mentioned, all the tokens that are issued are placed on the blockchain on a cap table, so that we know everyone who's listed on your cap table. We can manage that. If they sell those shares to someone else, we know who that is, who's buying those shares. So you always know at 24/7 who is represented as an investor on your cap table. So hopefully that covers some of the regulatory.
Yeah, I think that makes sense. And so in terms of like growth and where the market is looking in 2024, you're working with both inside the U.S. as now you have your broker-dealer and all the exciting licensure here in the United States, but then you also have this multi-billion-dollar property in the GCC. So could you talk about the innovation and where that may likely be coming from?
Well, we're just seeing a lot of interest overseas because they're seeing it as a leveling basis that now they get a chance to compete with some of the stronger countries in the world by capitalizing their projects with other people's money. So they're really jumping into it because they know that this is going to take place, it's happening, and I guess they want to be first in line so they can actually take advantage of that growth. Like I said, if you tokenize and pull your equity out and you have very little equity in your asset, but you remain the GP, then you now have capital to continue to grow without having to find new capital from the same sources. But if you have your capital trapped in your asset, then you have to worry about selling the asset off to take your profit and then take that little profit plus a new capital to go buy something else. One is just a much easier process. So we're finding that overseas that they're really aggressive towards it. But here in the United States, we're also seeing interest from investors and property owners who understand what's going on. But what we're really trying to do, and the reason why we're growing our portfolio so large, is because we want to make sure that we capture the attention of the largest institutional investors in the world. To mention Nomura Securities in Japan, they're sitting on $25 trillion in cash, right? So they're looking for investments. They're looking for the same kind of investments that you have, but yet they would like these investments in digital form because we already talked about the reasons why. So our goal is to be able to build as many assets on chain to present to them, because now I'm bringing my broker hat back on and be able to talk to them more and say, look, we have all these assets. What are you looking for? And they say multifamily or office. We're able to show them that portfolio, and they can write checks for $500 million to $1 billion to meet their requirements. So that's where the market is headed, and we think that property owners should be represented in that market.
So Shayne, I want
to add a quick point to that, still sticking with the global theme. So Ed talked about institutional investors. Of course, this is also an opportunity for individuals all around the world to invest into assets that they couldn't previously do. And in terms of the rate of adoption of digital assets, it's actually the leading countries in the world are countries like Vietnam, Nigeria. These countries have a larger percentage of the young population adopting these digital wallets than we even have in the United States, which means they're already comfortable with this idea of digital wallets and digital assets. And for them to buy into top quality real estate is just an opportunity they never had before. So that opens up a huge new capital source for real estate owners to tap into via this model.
I wanted to kick the question back to you, Shayne, as well. Similar line of thinking. Ed and Don have been talking about the opportunities for access to distribution of more capital, as well as reduction in costs of managing a lot of these different properties. How do you see companies and clients working with Hedera to take advantage of some of those real business applications? Because the technology is really cool, but it's not a hobby, right? We need to figure out how to actually use this for our businesses. So where do you see the real opportunity with some of the clients that Hedera works with?
Yeah, so I'll talk about some use cases, but first, if you think about it, this is how I think about your world, not being a commercial real estate guy. Every property that you have ends up becoming like a publicly traded, assuming you tokenize it, becomes a publicly traded company. Let's say you have 100 shares. They've talked about, you put out 10% of those shares or 20% of those shares. That's the float, right? Like in a stock. And you still hold the 80%. Imagine doing that over and over and over again, and now you as a company, you're really the holding company of a set of real estate. You can then tokenize the ownership in your own company, similar to what KKR has done in going public, right? The same thing is, but we haven't seen that today in the real estate side of things, but it's coming, in my opinion. And so when we think about real world use cases that they go beyond just real estate. We do have tokenization around diamonds. So there's a company called Diamond Standard who has tokenized diamonds and, made sure that there's a yield related to that. There's a marketplace related to that. So when Ed talks about an exchange, diamonds are a commodity. It's on the commodities exchange, et cetera. There are other, supply chain innovation that's happening. How can I make sure that when I deliver a set of products to someone that pallet is the number of products, the type of products, et cetera? How is that memorialized on a blockchain so that I'm not having to issue credits back and forth? The list goes on. And so there are a massive amount, payments and fintech. There's we have down in the Caribbean something called WePay. I think they've renamed themselves Volt to do cross-border settlement in the Caribbean. We've got many of the banks that you've highlighted today that are using tokenization for settlement in the back office, right? When they're settling billions and billions of transactions today, you trade a stock. How many days does it take to settle on average? About 3. What happens if that's almost instantaneous? That's what's happening right now. That's the innovation that's happening that we as consumers, forget being a commercial real estate person, we as consumers haven't seen yet, but it's coming. Because if they can save 2 bips, 3 bips on all of the settlement that they're doing, it's a massive amount that goes to the bottom line for these banks. And so we're just continuing to lean in. We want to be that technology layer that we're really, really focused on user experience. Today, if you as a consumer are trying to use a digital wallet, a token, it might be clunky, might be a good word, or it might be really technical, and maybe you are technical. We've got to get where it's like really, really, really simple. where it doesn't have to change your behavior to engage. And I think that's what I applaud RedSwan for doing, is because they've made user experience paramount. They're focused on the things that they do well, and the technology enablement layer for you to transact, for a consumer to transact in a very, very user-friendly way without having to change the behavior and do something different just because the underlying technology is a blockchain. The moment that you don't know that you're using a blockchain will be the moment that this entire space explodes.
Great answers from everyone all around. We're about halfway through, so I do want to take a quick pause and see, does anyone have any questions that they want to ask? I've got probably 45 more, so you don't have to worry if there's no questions, but does anyone have a question? We do have a couple, so I can pass the mic over here.
Are y'all at RedSwan and at HBAR, do y'all have the capability to distribute dividends from the real estate assets via the blockchain, and are y'all currently doing that?
Yes, we do. And so to the point that Shayne just made, because we know that we're going to have a mixed audience, we're going to have some folks who are more tech savvy, more comfortable with these digital wallets. We're going to have other folks who are not yet so comfortable. We actually support both options, both in terms of initial investment when people are buying into the assets, as well as dividend distribution. As a user, you can make a choice. You can choose to wire your money in, pay by credit card, or you could pay with a stable coin like USDC or USDT, which is basically a cryptocurrency, but it's tied to the US dollar, so we don't have volatility. So we keep those different options open so we can meet the needs of a wide user audience.
Yeah, so to that point, just real quick, USDC, as he points out, is pegged to the US dollar. So if you were to buy, it stands for United States Digital Currency. So if you were to buy one USDC, you could trade that for $1 US. So it's pegged to that. And so today, one of the concepts related to blockchain, and Ed mentioned it in passing, which is staking. So if you went and bought a digital currency and you wanted to stake it, meaning you wanted to tie it to a specific node, you could do that within your wallet, and it yields whatever the staking reward is. It may be 2%, it may be 7%, and so as long as those are sitting attached to a node, you're going to earn 7% of however many tokens are attached to that node. That same concept is related to dividends.
Yeah, so it's cool because you can use the...
Yes.
They can pay and receive either via regular fiat currency or via a digital currency.
Yeah, that's what I was going to say, is just that with smart contracts technology, once an investor has linked their wallet, now the underlying real estate property can just programmatically handle those distributions, which is much more streamlined than having to handle it from a back office, which if you've had distributions before, you know how complicated that can be. Handling that process programmatically can be really valuable. We do have another question over here.
Can you tokenize properties that have long...
Can you tokenize properties that have long-term fixed-rate debt on them?
Yes, because when we tokenize, we're looking at the net equity of the property. So that's beside the debt. Because we're focusing on equity right now because debt traditionally is much cheaper to get than equity. So we would look at the net equity value. So you have a $100 million property with $50 million of debt. We're looking at the $50 million of equity of that property and probably tokenize up to 90% of that to pull out. Good question. So most banks, we read
The question was, do you need to notify your bank?
Yeah, the question, you have to notify your bank. We typically, during our due diligence, review the note, and the note will tell us what the situation is that the bank requires for, most of them require that the KP has to remain in with their equity in the project, and that any new investor being transferred cannot have more than 20% interest in the actual property. Otherwise, the bank will have to review you like a KP, and therefore it may slow down the process. But as long as the investors are under 20% in terms of ownership individually, the bank is typically okay. And we've done this even with a HUD loan as well. Yeah.
So, thank you, gentlemen, for being here today. I'm a crypto guy in some circles. I'm a real estate guy in other circles. And I really have a question for the speakers, but I'm interested in clarity from your audience because you asked how many people have real estate, but I'm curious about how many people actually have crypto, if just from a show of hands. So significantly less. So it's kind of interesting that y'all are discussing the wallets and all the technical functionality that's the under the hood piece. And Shayne, you eloquently addressed that as mainstream adoption becomes extremely important. I'm interested, as Ed and I have discussed, about how do I tokenize parts of my portfolio, and I'm concerned about the title and how do you ensure that the chain of title is clean before you tokenize it, and then ultimately the KYC, AML, and the compliance requirements that you're not selling into the secondary markets into what might be deemed a bad actor. And then if you become complicit in providing this conduit to the financial services that it represents. And also I want to commend you, Ed, and RedSwan on your crypto EQ report coming in on radar, which just reaffirms the importance that this is a project that we should have our eyes on. It should be on our radar. So congratulations.
Thank
I'll
you,
let
Sheldon.
you address those.
Yeah, to address the question with regards to verification of the real estate, just like we would do the verification of the value of the asset and look at the equity side of the asset, the net equity, we're also looking at the registration, how that real estate is registered. And typically there's a SPV that's controlling the real estate. And through that SPV you have the GP shares and LP shares. So that's typically the way it's done. So we would just verify that that SPV actually owns the real estate, and then we verify how much equity can be tokenized and issued. And then we leave it up to you to determine how much you want to raise based on what we found out. The second half of your question was?
I think there was a point about also the KYC and making sure that these assets don't end up in the wrong hands. So we conduct KYC AML checks in the first time around when we sell the asset, which we call primary issuance. It's the first time that you sell your asset to the public. But even when somebody who buys that asset then subsequently decides to sell that to another person, through our secondary exchange, that new person also has to go through a similar level of KYC AML. They cannot just transfer that asset to their buddy who happens to be a terrorist. It's still controlled within a regulated framework. So at any point in time, you know exactly who's in your cap table, even when it goes to the secondary and tertiary trades. Yeah, that's where it's a little different from, that's where the digital securities and the security token offerings are a little different from what people are doing with NFTs and what people are doing with utility tokens. So because this is regulated by SEC and FINRA, we still take advantage of a lot of the advantages of blockchain, but we have to have that level of control around KYC, AML. That's part of the mandate that comes from the regulators, and that's why we're able to control that.
And also, yeah, we won't get too technical with the keys, but yes, there's multi-sig strategy with the keys so that your wallet is accessed by you and your officers of your entity, but also you allow our broker-dealer to have access and the escrow agent. So we never touch any capital ourselves. So we want to take your shares, they're already sitting inside of your wallet, and the escrow officer has the authority with your approval to move shares from your wallet to the new buyer. They also have the authority to now collect money from the investor, puts it into an escrow. When all the money is now received in that escrow, they ask you if you're ready to now finalize the transaction. You say yes. They release the shares to the investor, and they release the capital to you, and then they release the fee to RedSwan. That's how it works. But you cannot, you with your wallet, your shares in your wallet, even though you own those shares, You can't sell those shares to a third party without going through a broker-dealer. That's why we have a separate broker-dealer division, which is the registered broker-dealers who are able to make that transaction. So when you want to issue, you go to us. We now issue those shares through a broker-dealer. If that person who buys those shares wants to sell it to somebody else, they come back, it goes to the exchange, is advertised, and the broker sells it to the next party. You cannot transfer back and forth to, peer-to-peer.
That was a great back and forth conversation, but as a reminder, this is being recorded, and so we want to try to ask as many questions as possible through the microphones. So keep your hands raised if you do have questions, because we are passing that microphone around. Thank you to Sandra for doing that. So keep her and try to make eye contact if you want the mic, but we do have one up here, so lead us off.
Great discussion, guys. Ed, this is for you. How would you ensure that there is liquidity and volume on your exchange all the time?
Well, real estate sells based on price point, right? I was a broker for 17 years at Cushman Wakefield. I take a property, I put it on the marketplace. I have people come and say they want to buy it, or they make an offer at a price. I go back to the seller and say, here's the price. So same thing goes for liquidity on real estate on the blockchain. You have a property, you want to put it out there. People are going to look at your property, they're going to look at the yield in your property, and they're going to make an offer. If what you're offering is acceptable, they're going to say, I want to buy it. If what you're offering is not acceptable, they're going to say they not want to buy it, and they may recommend a counter price. Unfortunately, on the issuance, we don't take bids. We have a set price, we put it out there, those people want to buy, they buy. On the secondary exchange, we do accept bids, because now, if you might want to sell at a higher price and the market's saying no, and they give you a secondary offer, then you might want to accept that. But that's how it works. But there's no guarantee, but I just tell you, as a broker, everything I've taken on as a broker, I've sold. Why? Because we find the right buyer for the right price. And the same thing we do here.
Not to mention, when you think about liquidity, it's not only trading from one buyer to another buyer, but there's also this opportunity of taking debt and having collateralization of the property, which is another form of liquidity for that real estate shareholder, and that may be another viable option for many of these properties. Next question.
Yeah. This thing on, yeah. Shayne, this is probably a question for you regarding the blockchain ecosystem. Are you guys creating kind of a walled garden? You're a permission blockchain. Do you have, and there's other protocols that are kind of doing this where you're creating like a white label, pre-authorized marketplace for this? Because, is a permission more, I wouldn't say centralized, but when we think about where the regulatory environment, and this is definitely more of a U.S.-centric question, but are you guys looking to create kind of a marketplace if we do get some sort of, movement from the SEC and the Elizabeth Warrens of the world to create something like that?
Yeah, great question. And so let me differentiate. So Hedera is the underlying technology. What I represent as the CEO is something called the HBAR Foundation, and we are the premier ecosystem development organization. So we give grants. So to your question, we would give grants to organizations that would want to build those marketplaces. And so we would understand their business model, and we would grant them, $200,000, $500,000, whatever the business, really needed to get up and running, prove itself out on chain as a result. And while we're public permissioned, we're still very, like other chains, we're open sourced, fully open source, so that anyone can build on us. You don't have to be a governing council member to build on us. So if you felt like, hey, I want to build the marketplace, you could certainly come to us for a grant. But the other thing is you could just download the open source code on GitHub, have your developers start writing it tomorrow, and away you go. And we can make the introduction. So we both provide financial support, but also technical and business support. So let's say, for example, we weren't at this event hosted by RedSwan, and you're like, man, I really want to get with those RedSwan guys. I really want to figure out how to integrate my marketplace with their products and offerings. We can make the introduction to Ed. We do that all the time, each and every day. And then lastly, we're global. So we've got folks spread across Europe, along with Singapore, all over the U.S., in Dubai, in the Middle East, et cetera. And so we were able to reach pretty far in order to make the necessary introductions. Does that answer your question? Okay.
Just wanted to thank Ed for taking a lead on the real estate tokenization within the Houston ecosystem. So Ed, congratulations. Everything that you're doing is phenomenal. Question for you, Shayne, further on the liquidity aspect. When we look at Hedera and the, I believe if I'm correct, you all have a few $1 billion worth of liquidity that, that can be accessed. With respect to the real estate tokenization, as Ed mentioned in the introduction, there is going to be trillions of dollars of real estate, that's coming into the market. What gets sold in the primary and then subsequently what goes into the secondary and the interplay that happens between the primary and the secondary, there has to be a substantial amount of liquidity in the market to address the sheer size and the scale and the volume that real estate industry demands in order to get the whole tokenization get going in a significant ways. So would love to hear what Hedera is looking at, and is there an aspect of interoperability between different and cross chains perhaps that you all are looking at or thinking about so that a broader spectrum can be dealt with?
Yeah, so what he's referring to is the currency that drives the transactions on our network are called HBAR. HBAR is the cryptocurrency that is used to execute every transaction and pay for that 1,000th of a penny type of transaction. But you've got real estate and or other decentralized finance type products that are running on chain. And so how do you improve the liquidity if I want to move from an HBAR to USDC, or I want to take my dollar and move it into USDC or move it into some other type of cryptocurrency or token or stablecoin, as an example. And so there are partners, Circle as one, that, making sure that we're increasing the USDC liquidity on chain specifically. We have a couple of bridges that are coming online that are going to continue to give us the cross-chain access. So if you want to move from, and now we're getting in the cryptocurrency space, if you want to move from Solana to us, or Avalanche to us, or us to Avalanche, et cetera. So being able to move funds and have those technical integrations is something we're very focused on. We've been focused on, but I will say that we have not been focused on specifically Wall Street up until about the last 3 months, largely due to the lack of regulatory clarity. We're a bit more conservative as a chain, and so we don't necessarily need first mover advantage. And so now we're specifically working with many of them to specifically focus on our liquidity strategy, increasing the number of bridges, layer 0 being one, and others that are going to be coming online to give us that cross-chain access of liquidity, wrapped ETH to HBAR, et cetera, et cetera.
And I'll just add, I think, as Ed and others have mentioned, there's trillions of dollars of real estate will ultimately be tokenized and go through this first stage, which is what we call primary issuance, which is effectively the IPO of the asset, the first time it becomes available to the public to buy. So I think there are a lot of benefits to folks to just participate in that first issuance. If you have somebody who is maybe in a country where there's a lot of inflation, they might be interested in just buying into that asset and holding it for a little while, even if there's not a lot of opportunity to immediately trade it, because now they have a dollar-denominated asset of value in their investment portfolio. And then as more and more of that primary issuance happens successfully, now you have more folks who are holding these assets, and now you have more liquidity for the evolving secondary market. So, it'll take a little time, but I think there's enough of a use case, or there's enough of a value proposition for folks in the first issuance to get that going, and then that will in turn drive the momentum in the secondary market as well.
And I think one other point, so with the treasury that we manage, so when we got funded as the HBAR Foundation, we had 5.35 billion HBAR at the time that were worth $2.5 billion. And that fluctuates based on the price of HBAR, as an example. But in our strategy, a lot of it is we will seed liquidity if the market and or the product is actually there, right? So we make sure that we try to build healthy marketplaces around assets that would be traded. so that that initial liquidity is there, and then over time we're able to pull our money out ultimately.
Makes total sense. Do we have any more questions? We got one here, and we have a lot of hands, so keep your hands up. We may try to get to all of you, but we have about 10 to 15 minutes, so we'll try to get to them all. Panelists, just try to be short and brief with your answers so that we can get to as many as possible.
Thank you very much. Quick questions. I think 3 points to my questions. The first one is I'm curious about the underwriting process to take on new properties. So something comes from the Middle East, like the portfolio you've shown. What is the underwriting process? How do you come up with the valuation or the price? The second one is in terms of requirements or limits, what size do you look for? Is there a minimum? Is it, say, 10 million, 100 million, $1 million for the properties that come onto the market? And I think you touched on the other one, which was the bid-ask spread. I think we talked about it quite a bit. But the last one is in terms of asset classes. I think, Ed, you mentioned you're looking at Class A properties. And since you're going global, I'm from Africa, and I think the predominant asset class there is land. Everybody buys land, and the wealthy buy lands. And, the not so wealthy are not able to afford it. But I look at this, and I think that would be a great opportunity. Is that an asset class you will be willing to touch on?
So we got valuation underwriting.
Yeah, so valuation underwriting, we have skilled real estate experts in our team that can evaluate most assets here in the United States. But an asset like you just saw, this $4 billion portfolio in the Middle East, we actually commissioned Cushman & Wakefield to do the valuation of the entire portfolio. So their stamp is on that valuation. And we can use also EY or Deloitte Touche. They're all there to work with us, provide on-the-ground assessment of the asset as well as the valuation of the asset. And in terms of minimum size, yeah, we're a little bit, I won't say snobby right now, but we are trying to go for the larger transactions, again, because that's what the institutions want. And usually when the institutions invest, the public follows them pretty quickly. And so we want to pull larger transactions to make sure that we have the largest blockchain marketplace in the world, so that any institution looking to invest in digital currency or digital assets of real estate will come to RedSwan first. And that's great for all the owners because they get to see the projects we have. And sometimes, institutions have told us they don't want to buy individual assets. They don't have time to, like BlackRock doesn't have time to look at one apartment building in Houston or one apartment building in Los Angeles. But if we pull them together or look at the entire portfolio, that way they can write a $200 million check or $500 million check. So one thing we're doing is taking some of the individual assets and pulling them together in the portfolio and sharing that with the institutions as well. To your last question about Africa, and we opened an office in 2021 in Lagos, Nigeria, just because we see that market expanding, as Don said, in terms of the adoption rate of people using blockchain cryptocurrency. Vietnam is number 1. I think Central Africa is number 2. India is like number 3 or 4. And so we want to make sure that we can capture those customers because dollars are dollars. You don't care where it comes from as long as they're KYC'd and they can bring you capital. You don't care if they put $50 in or $5 million in because we manage that cap table for you. You don't have to deal with it. So we do have a minimum for us. I mean, we look around $70 million of value for asset. But we're trying to get portfolios that are in the $100, $200 million of value just because it's more interesting to the end user for us right now. And I think that's what's going to move the needle faster. But in terms of land, we don't really tokenize land. We look for projects that people are building on the land. They either have some level of financing for building their vertical, and we'll support some of the equity to do that. But we won't tokenize land by itself. We want income-producing properties so that our shareholders or our customers will actually get dividends, some kind of a yield from the asset. So that's what we focus on early, and that's because we have a small team. As we continue to grow, we'll probably lower that threshold and start doing $20 million, $30 million deals as well.
Keep the conversation going.
Yeah, I had a quick question on clarity, Ed, on the multi-sig. My experience with multi-sig has been that if, you have to have, a certain number of people agree to a transaction happening with a multi-sig. Is it with yours because of the compliance? Is that not the case? So if the broker-dealer could essentially move a token holder's asset or tokens without their permission? Or does it have to, do they have to go back to that token holder? Is it forced? Is that multi-sig forced back to the token holder to say, hey, by the way, we're doing this transaction?
That's correct. That a broker is a three-party authorization in which all three parties have to say yes for something being moved. Exactly. And even for minting purposes, we don't just mint without the sponsor saying, yes, this is correct, go ahead and mint and give permission to mint. Otherwise, we can just mint 10 billion tokens on one asset, which is not correct. And then also we mint not into our wallet, but right into the sponsor's wallet itself so that you're in control of your asset. And even the investors who are buying, we don't hold their wallets. They're self-custodying all their assets so that they buy 10 tokens or 10,000 tokens, it goes into their own wallet.
Okay. Yeah, it's actually interesting. When we went through the SEC FINRA review to get our license, apart from reviewing us as a business, they actually reviewed the technical platform and the step-by-step workflows and made certain recommendations. And one of those recommendations was that the sponsor, which is you, the owner of the real estate, has to give explicit approval before we are able to mint and transfer tokens to the new investor. So that was actually an SEC requirement. We had to then code that into the technical process.
Ed, is it okay? Ed, 3 years ago, I think one of us said, if you build it, they will come. So congratulations, you built it, and they have come. So congratulations, thank you for having us. Just two quick things that haven't really been mentioned. Maybe you could touch on the, first, the efficiency that you're creating in probably one of the most inefficient marketplaces that there are as far as the transactions go. Secondly, the transparency and the information that's provided through both your own due diligence and then ongoing due diligence.
Well, in terms of the transparency, I think it's really important that people know what they're buying. And unlike a REIT, sometimes you might buy into the brand of a REIT. You don't have an idea of all the different assets that are in that REIT, and you don't have an idea of what type of capital costs are involved in that REIT. So your dollar in a typical REIT situation, you pay a load fee to come in, and then even with the further investment, your dollars is maybe paying for salaries or some overhead costs, and then finally your money goes right to the actual real estate in the REIT. In RedSwan, when we tokenize an asset, we charge the customer for a fee to actually sell that security. So investors coming on board, first of all, they get the financial statements. They get to look at all the financial statements with regards to the property, do their desktop due diligence, so they know what they're buying. And then their dollar goes directly to the equity of that asset. So we're not charging them a fee. We've charged the owner a fee already, so their money goes directly to the asset. And then, being that you are in the business and you are involved in digitization of documentation, and we use companies like yourself to provide continuous documentation of the financial statement. This is an add-on for sponsors, but we think it makes a lot of sense because it saves sponsors time so that daily it can scrape information from your bank to understand the differences and changes in your financial position and let the token holder see that as well. So if they have to make a sale, they can actually know what happened yesterday in your business, whether your payroll was up by 1% or down by 1%. They can analyze that and make a decision on how they want to price that asset. And I think when you start looking to the future and there's a lot of high volume trading going on, that information, 24/7 is going to be very important to make good decisions.
Two more questions.
This is Vijay Pitt. I'm with a company called Zenvest Capital. We are into land banking. We own or control directly or indirectly over 20,000 acres of land in Texas. My business partner, he controls over 5,000 multifamily units. We have two questions. One, being a real estate asset, what is the extent of title claims in case a wallet is hacked by somebody else? We do the tokenization, the wallet gets hacked by somebody from somewhere in North Korea. What is the extent of a title claim on the land I have in, let's say, in Houston? Number one. Number two, in case, let's say, in case I'm a multifamily investor, I get a deposition right of 100%. I got tokenized it. Now I've somebody owns 0.02% of the asset. Does it still get to claim deposition write-off? Does the K1s pass through? I know a little bit more details questions, but what's your take? What's your experience on it?
Let Don talk about the hacking security of the...
Yeah, so yeah, again, that's, I think that to repeat the question was, what if an investor buys, your tokens for your real estate, and then at some subsequent point that investor's wallet gets hacked, what's the recourse there? So again, this is one of the cases where this is different because it's a regulated industry. This is different from what happens with Bitcoin and so on. So in this case, if you remember, I mentioned we always retain a cap table of exactly who the owners of this asset, of these tokens are. So even in the event, unlikely event, because we heard from Shayne all the steps they've taken towards security, but even if for some reason that investor's wallet is hacked, we have an ability to basically burn those tokens and remint them so that they're of no use to the person who hacked them, and remint the same tokens and reissue them to the rightful owner. Because we have to do our KYC AML and keep a record of the cap table, we always know who the legitimate owner of those tokens is, and those tokens always link back legally to a physical piece of real estate that we all can see and understand. So you don't have that same level of risk that you do with if somebody hacks your Bitcoin wallet, your Bitcoins are gone forever. That is not the case in this scenario. I think the second question was around K1s and tax benefits. Was that it? Yeah. I might pass that on to Ed here.
I'm not a CPA, but you have the same benefits with regards to taxes as you would if you're investing in a stock and you have short-term or long-term capital gains. That's how the same benefit. Right now, you do not have the benefit of a 1031 exchange. If that's the question you're asking with regards to tokenization. I think the IRS is way behind in terms of where the technology is. They'll probably catch up in time, but as of today, that is not a case where you can roll over a profit into another piece of real estate. I think that's in the future to come. But if you do make a gain, you get a K1, so you'll be able to report your gain or loss on your personal tax return.
And our final question before, of course, you can come talk to Ed here at the front. I don't know if we're going to get to, unfortunately, we've got the mic over here.
Can you talk a little bit about transaction fees? Obviously, in real estate, we're used to the brokers being able to sell and earn a transaction fee. This changes things quite a bit. Y'all are a broker-dealer, and clearly you can earn a transaction fee. Does that get shared with the sponsor, or is there some sort of capability, given that real estate can now change hands daily, monthly, yearly?
Yeah, unfortunately, we can't share in fees in terms of broker-dealer fees because you have to be licensed with FINRA in order to be able to share in that fee. We can't even share with the sponsor a fee, so we can't kick back a part of it to the sponsor. But there are marketing fees that we could work with people on when they bring new business. We're able to pay a fee for marketing, that's business development, but we just can't pay a fee on the actual issuance or sale of a digital security.
And I think on the secondary trading, just like you have on any trading exchange, there'll also be some trading fees there. That's another longer-term part of the business model.
All right, well, please come together. Oh, we have another question. Great.
All right. I hope you can hear me. Ed, congratulations. We've tokenized, we've raised the money, we're into a years of the process, and the GP wants to monetize. What do we have to go through if we want to monetize and exit that asset?
That's a good question. So you're saying that you, as a GP, have tokenized many of your assets, and you have this GP layer that maybe controls 10% of equity on paper, but now you want to liquidate your GP position. Is that what you're saying?
Liquidate the entire asset, so all 100%.
Okay, so as a GP, if you tokenized your equity and you sold off 90%, then you only own 10% of the asset. but you control the management of all the assets. If some reason you wanted to unwind the situation and buy out all the shareholders, then you would do, an offer to buy out all the shareholders, and then they have to accept it, and then you can now, take back full ownership of the asset. But if you were a GP and you wanted to sell, the massive assets under management that you've accumulated by tokenizing and buying and tokenizing and buying, then you can actually tokenize your GP share structure and sell that to a larger GP, and the shareholders will probably approve that because you're bringing on somebody larger that can actually manage the assets on their behalf.
So just to dig a little bit deeper, so if all of you are a partner with us in a transaction, I normally would call each of you and say, hey, we have an opportunity to monetize this asset. Market has peaked, et cetera, et cetera. You would render a vote, and we would go collectively to sell that asset.
Yes.
That's really what I'm asking in the spirit of the tokenization world. Do we do that same type of process, that we go to all the token holders and say, hey guys, we think as a GP and the manager that this asset has reached its peak and we'd like to monetize, yield your profit, and take your money back?
You could do that. I mean, they're voting, they have shares, they can vote on their pro rata share of ownership. You can tell them that you believe that this is a great transaction. As a GP, they're probably going to follow your recommendation because they trust you is why they bought your asset in the first place. And if they say yes, then you can do that. But you just can't arbitrarily, if it's the GP, to sell off their assets or put a price tag that they have to sell their assets off. You have to have unanimous decision amongst the shareholders in order to make that happen.
Have we seen this full circle take place yet?
Not
Are we
yet.
too early in the circle?
It's too early for that. I mean, we're still in the growth mode where people are just trying to monetize their assets, but we haven't seen the situation where even the issues where if shares have been issued, I haven't seen customers come back and say, I want to sell yet. I mean, I think it's still the mindset of many owners that I'm buying real estate, I want to hold on to it for a while. I think it's going to keep improving in value, as opposed to I want to trade it because it went up a couple cents today. I want to trade and get out like Bitcoin or cryptocurrency. I think the mindset is still I'm going to buy and hold on to it for longer term.
Please join me in putting our hands together for our unbelievable panelists. Ed, Don, and Shayne, just such a wealth of knowledge you all are. And man, the crowd, this is maybe the best group of individuals asking really smart, really engaged questions. So you made my job easy today. So thank you so much to our venue, to RedSwan, to Hedera. This has been unbelievable. Thank you all so much.
Yeah, thank you. I do want to say one thing, though. That we do have this analyst report that was written about RedSwan. There's a company called Crypto EQ that did this. They do analyst reports on different companies in the tech space and blockchain space. So we are raising our final seed round. So if any of you are interested in getting this report, just see me and I'll give you a report to take, or I can send you a soft copy. But thank you very much for coming. This was a great turnout. I'm glad to see so many property owners and investors and people in the tech space. Houston is definitely a great city for technology, and I think it's turning the corner. So we're here, we're based here full time. If you have any other questions, you're free to come by our office on the 3rd floor, and I'm happy to talk to you directly. Thank you very much for coming.